One of the most popular questions investors have is about dividends because it's a pretty reliable way to generate income from your stock portfolio. So let's start with the basics. A dividend is a payment that shareholders receive as a portion of a company's earnings. So when a company is profitable, management can either reinvest those profits to grow the business, or they can distribute them to shareholders as dividends. Now, you typically see younger companies and fast-growing industries like tech. They will typically reinvest their profits to fund new projects. Now, here's a great example of a big tech company that is profitable but doesn't pay a dividend. This is Cadence Design, which designs chips and printed circuit boards. And you can see that it's been very profitable for years, but does not pay a dividend because it's in a rapidly changing industry and prefers at this stage to put the profits back into growing the company. But here's another stock. This is Procter & Gamble, which makes a whole lot of brands that you know about and probably use some of them. Procter & Gamble is a large, well-established company and not only pays a dividend, but has a 67-year track record of distributing profits to shareholders in the form of dividends. The most common way companies pay dividends is with cash, which is deposited into shareholders' accounts at their brokerages. For example, if a company declares a 25-cent dividend and you own 100 shares, you will receive $25. Many investors want the income associated with dividends and tend to view them as a sign of strength and positive expectations for future earnings. Companies often pay a quarterly dividend, but some pay semi-annually or annually, but quarterly is the most common, which you'll see most often. Now, keep in mind, companies are not obligated to pay a dividend, and they can reduce it or stop paying it at any time. And some companies whose earnings declined or became unprofitable in 2020 because of pandemic restrictions did cut or eliminate their dividends, although many have since brought it back. So let's talk about how you receive your dividend. You need to own the stock and be what's called a shareholder of record on a particular date. So here's an example of a recent Apple dividend. The company declared a dividend on February 2nd. The payment date was February 16th when shareholders got their money. But to do that, they had to be shareholders of record as of February 13th in order to get that dividend. Okay, that's not bad to keep track of, but here's another date you need to pay attention to, and that's the ex-dividend date. Because any stock transaction, including a dividend payment, takes a few days to clear, there is a cutoff before the record date, and that is called the ex-dividend date. I didn't make this stuff up. I'm just telling you what it is. So in simple terms, if you buy the stock on or after the ex-dividend date, you will not be eligible to receive the upcoming dividend. I know. That's a lot of dates to remember, but it's actually pretty simple. You just need to purchase a stock at least a few days before the record date to officially own it in time to receive your dividend. And if you're too late, you'll get the dividend in the next quarter if you still own the stock. I mentioned that most dividends are paid in cash, but you can also opt for an automatic dividend reinvestment plan called DRIP. And if you don't need to withdraw cash and are still growing your account, I recommend this. With a DRIP, dividends are automatically used to purchase additional shares. You get it? Cute little acronym for dripping the dividends back into your account. It's kind of sweet. This allows you to accumulate more shares over time and can potentially compound your returns. Although remember, you will be owning more shares of that stock. So what's the overall advantage of dividends? Well, they can provide income and potentially boost a portfolio's overall returns. And here's something interesting. And investors who only focus on price appreciation completely miss this point. Dividends create income in all market cycles, including bear markets, and are a very important part of your total investment return. Since 1926, The U.S. economy has undergone many bull and bear cycles, and since then, dividends have contributed approximately 32% of the total return for the S&P Large Cap Index on average, while price appreciation accounted for 68%. So another term you'll hear is dividend yield. And here's a quick way of understanding that. Yield is the percent return that a stock or bond pays over a year. So for dividend stocks, that yield is the sum of the last 4 quarterly dividends divided by the price of the stock and then multiplied by 100. It's easier to look at an example. Say there's a $20 stock that over the past 4 quarters paid dividends of 10 cents, 10 cents, 10 cents. Then they raised it to 20 cents in that final quarter, totaling 50 cents a share. That means the stock has a dividend yield of 2.5%. Dividend yield tells you how much return you're getting for the price of the stock. Dividends have a lot of great advantages, but it's not the only reason to invest. You also want that price appreciation. And it's important to remember that dividends are not guaranteed. Companies that pay dividends may not be able to sustain them. Here's Royal Caribbean Cruise Line, which had to cut its dividend after the March 2020 quarter for some very obvious reasons, and still hasn't brought it back as of March 2023. The company is still clawing its way back to profitability. Clawing's probably not the best thing for a cruise line, but there you go. Despite some risks, dividend-paying stocks are a good way of generating income while still allowing for the potential of stock price return. Hey, please don't forget to like and subscribe. It helps me spread the message of smart investing to people just like you who want to make the most of their retirement savings. And I will put a link in the show notes if you want to contact me at Blue Marlin Advisors for a no-obligation consultation and review of your portfolio. Thanks again for watching today.